Hello students, and welcome to week 4 of Monitor and Control. And in this week we really start with the finance topic. So we start with looking at what a balance sheet is and what the different items of a balance sheet are. So we have 3 learning goals. The first thing is explain the nature and the purpose of the 3 main financial statements. Then we look at the balance sheet and understanding the most important components, and then we look at the layout of the balance sheet. So let's start with explaining the nature and the purpose of the 3 major financial statements. Well, if we look at the 3 major financial statements, or classify them first of all, or list them first of all, we can see that we have a statement of financial position, which is the balance sheet. We have an income statement, which is also called the profit and loss account. And finally, we have the cash flow statement. Well, looking at the first one, balance sheet actually means what is the total amount of wealth that is basically present within a company. So what is the accumulated, or also called total wealth of a business? So all the resources that are there, and how are they financed basically. Then we look at the income statement, which is actually about how much wealth was generated over time. So the difference between the first one, the balance sheet, and the income statement is that the balance sheet is basically a snapshot, a photo of the company at a certain point in time. So you make a photo of the company and say the wealth at this point in time is so much. And income statement just looks at a period of time. So from this point of time in time to this point in time, basically a certain amount of wealth was generated. So this is about a time period. And the first one actually is about just a moment in time. Finally, we have the cash flow statement, which is about the cash movements that took place. So all the cash in and outflows. So you might ask yourself, well, what is the difference between the income statement and the cash flow statement? Because both of them look at flows of money, or flows of income, and also outflows. But there's a very important difference, because not all the transactions take place in cash. But we'll deal with this in the later weeks. So first of all, we look at balance sheet, then we look at income statement, and then we look at the cash flow statement. The important thing here is that all statements taken together actually tells you more about how healthy the business is. So basically how healthy it is in compared to competitors, if you compare the statements amongst each other, or also compared to the last years in which the business existed. So taken together, there's a good measurement of health of the business. So let's now start looking at the most important items of a balance sheet. And well, I brought you one from Tesla, which is publicly available online if you go to the investor relations part of their website. So you can see a balance sheet here, you can see a lot of different items, and the first thing we have to do is know which major items exist in a balance sheet. First thing is assets. You can see the assets are the ones that are in blue. Assets are all the resources held by a company. Then we have the lower part over here, which is about the liabilities, which is the obligations that still have to be settled. So the company still has to give money to somebody else, to external parties. And finally, we have equity, which is the claim of the owner against the business. These 3 parts are the main parts in a balance sheet. And what we do now is basically classifying what the 3 parts actually mean. So let's look at the most important components. We already discussed it briefly now when we looked at Tesla. But most important components are that we have assets on the one side and claims on the other side. And claims were liabilities and equity. So liabilities being the claims of outsiders, and equity is the claim of the owner or the owners of a business. And the most important thing, since it's called balance sheet, assets and claims need to balance. Because assets are all the resources held by a business, and claims is basically how those resources are financed. So there has to be a balance, otherwise something is wrong. And this is the relationship that we actually consider when looking at a balance sheet. Balance sheet equation is assets equals claims, or you could also say assets equals liabilities plus equity. Important is also that you can further classify assets and liabilities. There are current assets and non-current assets, and also current liabilities and non-current liabilities. And well, this is something we have to understand now when looking at the next slides. So let's first of all look at assets as a whole, because there are certain criteria that have to be fulfilled in order to call something an asset. The first one, and all of them have to be fulfilled at the same time. The first thing is there a probable future economic benefit. This means if you buy something, do you expect to gain more wealth from this in the future? So let's say you buy a machine, this machine helps you produce your product, you can sell the product, so the machine helps you generate money. Then does the benefit arise from a past transaction or event? So this actually means in the past something has had to happen so that you can actually use that asset. So let's say in the case of a machine that you bought, the moment in time when you bought the machine, when you, let's say, signed a contract, I want to buy this machine, or just go to the shop and buy it, this is the past transaction or event, because in the past you took the deliberate decision to buy something, you paid for the machine, or you bought it on credit, and this is the past transaction that is involved. Then, is there the right or a right to control the resource? So this means, do we have the exclusive right to actually tell the resource what to do? So if we look at a machine, we can just push some buttons and the machine does exactly what we want, unless there's a defect or something like that. But it's not meant with this. What is meant with it is that we can actually control what the resource is doing, we can control where to put it, we can control how to use it and what the machine should be doing. So that's meant with the right to control the resource. And finally, what we also have is, can the resource be reliably measured in financial terms? And this simply means, can we put a money stamp on the asset? So if you buy a machine for 1,000 euros, we know exactly it was worth 1,000 euros when we bought it. So that's what is meant with measurable in financial terms. And so whenever now we look at certain resources, we can look at this checklist and see, well, asset or no asset. And you can also do that for your own personal things that you own. So you can actually classify if you have certain assets or if they're not classified as assets. Let's now look at, as I said before, there are two types of assets, current assets and non-current assets. Let's start with the current assets. Current assets actually are those resources held for short term. And short term actually means less than 1 year. So those things that you possess in terms of resources that you keep for less than a year are called current assets. So important thing is they are for sale or consumption. So you as a business sell them or you use them for other parts of your business. They're sold within a year or used up within a year. They're held for general trading purposes. And finally also they're cash or near cash. So if you have very short-term liquid investments with certain banks or comparable investments, then this is also called assets, because you can transform them very quickly into cash. So everything that you can transform quickly into cash, this is what is meant by near cash. So this is a kind of definition of current assets. So let's look at some examples, and of course there are numerous examples for that, but I like to pick out those ones that you find most often when you look at balance sheets. So first thing is trade receivables, or also trade debtors. There's also another name given to it. This is actually all the business partners that you have, or the people that bought from you that did not pay you yet. So this means you sold certain products, but you give your customers, let's say 1 month, 2 months, 1.5 month time to actually pay the products. Of course you still sold the product, so you can recognize that you received something, basically, but in the end the amount is still outstanding, you didn't get it yet. So this other person that didn't pay you yet is a current asset for you, because you know this person is giving you value in the near future. Cash and cash equivalents, so all the notes and coins accessible on demand, so everything that you have in your pockets. And also liquid investments, like very easily convertible to cash. Like I said before, liquid investment with a bank or something like that. And finally, also inventory or stock, which are the products held by business for trading purposes. So the things you have on your stock that you want to sell to others or use in certain other ways is also a current asset. And these are, let's say, one of the most common categories of current assets. So let's now look at non-current assets. They're also called fixed assets. And they're basically those resources held for long-term operations, so more than 1 year. Important here is they do not meet the classical definition of a current asset. So they're not near cash, not only held for trading and something like that. But important is they can be either let's say, tangible products. You can touch, let's say, those things that you, let's say a table, you can touch, you keep it for more than a year, would be tangible. But also other things, like if you file a patent or certain parts of intellectual property, is something you cannot touch, so it's intangible. So non-current assets can also be intangible because let's say a patent is definitely representing value for your company, but you cannot touch it. And finally, usually non-current assets consist of property, plant, equipment, which is something like all the buildings that you own, the land that you own, machines, cars, trucks, fixtures and fittings, like those things you need for your offices and these kind of things. That's usually what is in there, but of course there are also, as said before, with the current assets, so many more categories. Let's dive into some examples of what non-current assets could be. So, lands and buildings, as said before. We can have certain furniture like tables, chairs, and so on. Cars, trucks, like all the motor vehicles that you can own as a company. Computer equipment, as said before, intellectual property, if you have a patent, if you have certain types of copyrights and stuff like that. Books that you use for your business, for training purposes, machines, and so on. So there's also numerous examples of what non-current assets are. Important is they are there for more than a year and they meet the classical 4 characteristics of what assets are. So important, as said before, they're held for longer than 1 year. So now we're finished with the assets. So we know assets are all the resources a company owns, either for the short or the long term. And now what we have to do is look at what liabilities are, because they're basically the opposite of an asset. You could say it like that. Let's start with current liabilities first. We said we had current liabilities and non-current liabilities. Let's start with current ones. There are those amounts due for settlement in the short term. So basically, we as a company still have to pay something within the next year. So quite similar characteristics as the current asset. They have to be settled within business normal operating cycles, so within a normal business year. They have to be redeemed or settled, not redeemed, sorry, but they have to be settled. They have to be paid back. They should also be part of the trading that is happening in the company. As I said before, it's settled within 1 year, and you are not allowed to prolong the settlement longer than a year. So you have to settle them within a year, and if you would basically be able to also say, oh, I'll pay you back in 3 years, then this is not a current liability anymore, but a non-current liability, which we come to in the next 2 slides, or in 2 slides. Well, this is the general definition of what a current liability is. So examples for that are, for example, trade payables, also called trade creditors, which is the opposite of a trade receivable. So basically, if we as a company bought something from our suppliers, but we didn't pay it yet, then this is called a trade payable. So basically, those amounts that are still owed to suppliers, let's say we bought goods from them, inventory from them, and we still have to pay them back, so we bought on credit. And finally, also a bank overdraft. So if we have a negative balance on our bank account, we also have to pay that back quite quickly. So it's kind of short-term borrowing that we do from a bank. So these are 2 examples, and as I said before, there are more examples, but those illustrate the idea of current liabilities quite well. So the last thing for liabilities is the non-current liability. And here you can guess from the name non-current, all those amounts due for settlement in the longer term, so more than a year. Here also they do not meet the classical definition of a current liability, so it means it's not for trading purposes, and also the other points that we had before. And they represent longer term liabilities. So usually if you go to a bank and you ask for a long-term loan, you will not pay it back within a year. If you, let's say you take on 100,000 euros, you pay them back over the next 5 or 10 years. And finally, they can be transformed into current liabilities, because if you, let's say you get a bank loan that you have to pay back in 3 years, and now 2 years pass, well, it's only 1 year until you have to pay it back, then of course it transforms into a current liability, because the time horizon is not 3 years anymore, but only 1 year, and 1 year is the definition of current liabilities. So now, after having a look at the current liabilities, the only thing left are the non-current liabilities. And you can guess from the name, those are those amounts that are due for settlement in longer term. So this means after 1 year. Non-current liabilities, as also the non-current assets, do not meet the classical definition of the current counterpart. So a non-current liability does not meet the classification of a current liability. So it's not held for, let's say, in general for trading purposes, and those things we discussed 2 slides before. As said before, they represent longer term liabilities, so everything that is due for settlement in more than a year. And finally, they can transform into current liabilities. So let's say we get a loan that is due for settlement in 3 years, and now 2 years pass. Basically, the loan is due for settlement within 1 year. So this means actually the longer term liability transforms into a current liability when the settlement date is shorter than a year. So you see, this is a very important difference, because the current liability cannot transform into long-term liability, but the non-current long-term liability can transform into a short-term one when the time comes. So an example for that is a long-term bank loan. So basically, if you go to the bank, you receive funds which you actually need to pay back in a time span more than a year. And so everything that you get from other people, from external parties, that you have to pay back in the long term, so after 1 year, is represented or is called a non-current liability. So then the last thing we have to define is what equity is. Equity is also called owner's equity or owner's capital. And this is basically the money or the funds that are representing the owner, or that are attributable to the owner. So this is the funds belonging to the owner of the business. So basically it could also be called the claim of the owner against the business. Important is that in accounting, there's a differentiation between the owner and the business. Usually, let's say you are having 10,000 euros lying around and you want to create a business, you put the 10,000 euro in and you think, well, it's my business, I am the business. But in accounting terms, that's not true, because you are the owner and you put money into the business. So now the money doesn't belong to you anymore, but to the business. So basically, if you put money in, it's seen as external to the business. So the owner is not the business. And that's a very important differentiation, because your own finances are separate from the finances of the company. Then if you look at owner's equity, it can also, of course, change. So you can put more money into it, you can take money out of the business again, so that changes owner's equity, but also the operating results that you make with the company. If you do very good, you create profit with your company, then this is affecting your equity because it goes up. Because the money you create belongs to you, because you finance the company, the company belongs to you. So also the money that is generated belongs to you. On the other hand, of course, also the money that you would lose. If you would have losses rather than profits, well, the owner's equity would decrease again. But this is also something we look at when we look at income statement next week. So, balance sheet layouts. We actually have 2 main layouts that we look at. So, first of all, we have the vertical one. So basically everything is written underneath of each other. We have the assets. Usually we start with the non-current assets, at least here. In Europe we do that. If you get to America, it could also be a different story. So depending on where you live, the layouts might differ a bit. But still, non-current assets are called non-current assets or fixed assets, and current assets are current assets, and so on. So the terminology doesn't really change, but the way the things are structured. Well, what we look at is that we do first non-current assets, then we look at the other part of equity and liabilities. But we'll also deal with that more when we look at the homework. That's basically how the balance sheet is set up. So you look at assets first, and then you look at liabilities and equity, or equity liability. It doesn't matter if you put equity first or equity last, but basically that's a general layout. And that's called the vertical format because we write everything underneath of each other. There's also another format, which is the horizontal one. So you put the assets to the left and the claims to the right side. And you can see it doesn't really change. It's just a matter of presenting. And you see it still balances because the total assets are equal to total equity and liabilities. And before it was underneath of each other, so it was 147 equals the 147 that was down there, but now it's just here. So it's not too much of a difference. And you can see basically there are certain terminology also in between. So total assets represents the total amount of assets, so non-current assets plus current assets. And here, well, total equity and liability, I think that's also quite clear. It's just summing up liabilities and equity together. So we just look at the layout of the balance sheet, so vertical and horizontal one. But also within the balance sheet itself, there's also a certain order in which certain things should be presented, especially when looking at the assets. Well, for the assets, the important thing is that the items should be listed in reverse order of liquidity. So liquidity means how near is something to cash. Because cash itself is the most liquid asset, because actually it can be directly traded for other things, so it's very liquid. So this basically means the assets that are furthest from cash are listed first. So those things that take more time to be transformed into cash should be coming first. And then the assets closest to cash come last. So cash itself comes last in the current assets category. Good. So now we actually finished the theory and we can put it into practice. So this is representing the balance sheet equation. We have the assets equals liabilities plus equity. And we have certain transactions on the left side, which I'm going to show you in the next seconds. And what our task now is to find out what are the effects of the transactions on the assets, liabilities, and the equity. So let's start. Joe Conde opens a business. He deposits 20,000 into the business bank account. So he takes 20,000 of his own money, which he puts into the business. So it's not his money anymore, but the business's money. As said before, equity is, the company is not the same as the owner of the company. So what happens here? Basically, he puts 20,000 pounds into the business. So this means actually assets, the current asset of a bank account goes up because he puts money into the bank account. Bank account becomes richer, so the current asset of a bank account goes up. Why is it the current asset? Because basically money comes in, you spend money for other things, so it's a back and forth with the money that is on the bank account. So what also happens is, since this money didn't exist in the company before, basically the equity goes up because it's something the owner puts into the business. So also equity, owner's equity increases by 20,000 pounds. So that's the first transaction, and it's still in balance because 20,000 on the left side and 20,000 here on the right side. Then he buys inventories for 8,000 on credit. So basically he actually goes to suppliers, says, I want to have certain types of inventories for 8,000 pounds, but he says, I'm going to pay you later. Or the supplier says, oh, you can pay within 30 days or something like that. So basically, inventories are current assets. He puts them on stock. They go up by 8,000. But what also happens is a liability is created because basically he has to pay them later in the next month or something like that. He's not going to pay them in 2 years, so that's why it's not a non-current liability, but a current liability, which goes up by 8,000, and it's called trade payables. So it's also in balance again. Then we look at the final one. A motor car is bought for 9,000 in cash. So this means he actually gets a motor car, which is a non-current asset because he wants to use it for more than a year, probably. So this goes up, non-current asset goes up. And actually his cash goes down, or the company's cash goes down by 9,000. And cash is also a current asset item, which goes down by 9,000. So as I said, cash as current asset goes down by 9,000, and the non-current asset of a motor car goes up by 9,000. So it's still in balance, but it's only a transaction affecting the assets and not any other part of the equation. So that was it for the lecture of today. And what I'd like you to do as homework is, first of all, think about if human beings can be classified as assets for companies or not. So look at the checklist of assets, those 4 criteria that we have. So measured in financial terms, control, past, transaction, and so on. And then tell me, well, can human beings be assets or not for companies? Then we have a bit of reading for you. We would like you to understand what there are certain accounting conventions which that businesses basically have to stick to. And we'd like you to read those in the book. So it's pages 50 to 53, Business Entity Convention, Historic Cost Convention, Prudence Convention, Going Concern, and Dual Aspect Convention. So we will not test this separately in the tutorial. So we're not going to ask you what is a prudence convention, what does historic cost mean, but we expect you to know that from the next weeks onwards, because we will from time to time touch upon them or they become important. And also in the exam, it might be that we ask you about those things. So we'd like you to do a bit of reading and understand those concepts so that we can also discuss about things in which those conventions are actually necessary. We also like you to read Goodwill and Brands, page 55, and that is basically it. So you can see again here the sources. So we, for this slideshow, we only used the book that we have, so Accounting and Finance for Non-Specialists, and you can see the pages that we used for creating the slides. So if there's anything on the slides that you didn't understand, you can also go back to the pages and read again those parts. So especially when you later learn for the exam, this will be a good guideline for you to as to what to read. So basically, of course, everything that we do in the slides and tutorial is important. So everything that we have on there is exam relevant. And these pages then correspond to where you can find the information regarding how we set up the slides. So read these things again if you're not sure about what current assets are, non-current assets are, and so on. And then hopefully everything becomes clear. Thanks very much and have a good day.